there's a couple of things that concern me, and maybe not. Maybe we don't have an overall secular bear market, but certainly some type of rotation, maybe. And that's
Mhm.
because, and I talked about this, many times before. If you show that first slide that has the real GDP, yeah, the Goldilocks scenario. Back in the pre-Reagan era, pre late mid late 1980s, you can see there's these wide swings in real GDP. And then all of a sudden it gets real tight. And for decades and decades and decades, you can see there's been a lack of inflation and short-lived contractions and pretty tight areas. And you can see that those correspond with bull markets. And that's really the secret to sustaining a bull market, is to keep the growth where it's not too hot, it's not too cold. We've now termed it the Goldilocks economy. We're in that right now. We're in a real sweet spot, and maintaining that is what's important. And so, what has changed? Somebody asked me on Twitter recently, is that something that has changed systemically? Is that something that it's methodology? What's changed is the government learned how to flatten the boom and bust cycle and print money, and it started with going off gold standards and things like that. And so far, it's been a good thing. We don't know what the ultimate price is going to be. Probably a depression at some point. But we've been printing money for quite a while. So the disturbance of that is what the institutions are really looking for, as far as, if we get too hot, that's inflation, right? Then we've got to engineer a recession, and of course, if we go into recession, that's a contraction. Business isn't good. So right now we're in that sweet spot. We're still in a sweet spot here. The thing that I'm a little concerned about, and I've heard maybe a few people, not too many people, talking about this, but in the 70s, Nixon put pressure on the Fed to lower rates to help get reelected. And Nixon won. And but inflation doubled, and then it went up again and again until finally it was 14% by 1980. I remember, I think the prime rate was 18%. I was a kid, but I remember it. I used to go with my mother and sit in lines for gas. So right now, I feel like the Trump situation is sort of rhyming with that era, where there's this pressure on the Fed, and it seems like the minute there's any weakness whatsoever, they're talking about lowering rates now, and that may be right. Maybe this a preemptive strike. Maybe we are weakening, and that it. But again, um, putting losing independence from the Fed is a risk,
Mhm.
and inflation. If you look, inflation is what we really want to avoid. Inflation is a tougher thing, and when you look back, you can see, we print money, we QE, and we can bring the economy back. But the inflation era persisted for a long time, and we just had a spike in inflation from COVID. But I don't see inflation has come down that much, and things are pretty good. I mean, as far as there's still growth, so I don't see this emergency, to cut rates. I know everybody wants to keep the market going, so I'm concerned about that. And when we take that in connection with, if you show, there's another chart. Bring up the chart about the concentration. Yeah,
Mhm.
right now there's out of the 500 S&P 500 stocks, market cap, 40% of the market cap is in 10 names. 10 names is controlling, is moving, is responsible for the movement of 40% of a 500 stock index. That's pretty extreme. All right, that is pretty extreme. And in the past, when this has happened, it didn't end very well. Also, if you look at the percentage of stock ownership, we're up there. A Gallup poll just said we're up about 62%. Our calculation minus pension funds, I think you have that chart also, um, shows, I think, about 50%. So again, historically high ownership of stocks. Now this could persist for a while, and maybe it goes more. But again, long term, there's a lot of ownership and there's a lot of concentration. So what does that mean? Well, it could mean a complete bear market and washout and something secular, or because the small caps and the mid caps have drastically underperformed for so long that I don't nobody believes it anymore. I mean, no, I don't think anybody believes that small caps are ever going to outperform the Amazons and the Netflix and the Palantirs. But at some point, there will be a major bull market in the small caps, and I think that's the next probably bull market in an area, in a big shift would be to smaller and mid cap stocks. So that's where I would be looking for emerging strength and a rotation, hopefully, as opposed to everything going down in a bear market. Shorter term, if you bring up the cycle work, September is the weakest month of the year. So, but you can see cycle work says we were supposed to be correcting back in July until October through the weakest month. We've kind of gone the opposite direction. If you can see the market's gone up, yeah, and the Dow and the S&P are tracking a little bit better. So maybe we get some pressure here, and then we get a strong end of the year rally. So now, with all that said, if stocks are breaking out of bases, I would say Mark Minervini's bearish, calling for a big bear market. Not at all. I'm going to buy the breakouts and I'm going to stick with the stocks. If they're still working, then I'm in the market. I'm not going to go and make this big opinion and then ignore stocks that are breaking out of bases. So, and as long as we see that, then I'll be in the market.